Adam.
Jared, thank you. We're going to keep talking about these markets and much more, and we're going to do that with Ryan Payne. He's president of Payne Capital Management and host of the Pain Points of Wealth podcast. Good to have you here, and welcome into the stream.
Thanks, Adam.
I was cheering when I read the note that you recently sent your clients, because you pointed out that so many analysts were saying this year would end on the S&P around 4,200. And you posed the question, is it time for Wall Street to up its full year projections, or are we expecting that pullback others are saying is headed our way? What do you think?
Well, first off, I think every analyst may just retire now and give up because they're never right. But I think, the bottom line here is it just shows you how wrong Wall Street's been all year. I mean, if you look at, earnings per share on the S&P 500, every single quarter, Wall Street has to keep upping their earnings estimates because they've been so off. By the end of the year, they could be wrong by like 40% based on what they thought at the beginning of the year. So I think there is a narrative right now because we did see a little selling earlier in the week. Didn't last that long, but we did actually finally get a little bit of selling. But are we getting to a point now where the markets are peaking out? We're at all-time highs. We have this proverbial sugar high because the government's created trillions of dollars that have just been bestowed upon the economy. And I think we have to look at is the momentum right now, Adam, is just so awesome. If you look at the S&P 500 over the last 5 months, it's been up over 5% each month consecutively, which is the first time since 1956. And when that happened in 1956, the market went on to go up another 25%. Could we see the same thing right now? I'm in the camp to say yes, we could see a melt up here.
Okay, so let's talk about that melt up, especially in regards to the S&P 500, because there are a lot of us who are old-time passive investors via our 401ks. We're very risk averse. We set it and forget it in an index fund tied to the S&P 500. But you also point out that just a few stocks in the S&P 500 actually, would account for some of these dramatic increases. Is that a warning to those of us who set it and forget it? And those stocks, obviously, Apple, Microsoft, Amazon. What do you say?
Yeah, I think right now, if you look at it, they're 22% of the index. So if you think you're buying the S&P 500, right, that assumes you have 500 stocks, you have broad diversification, but you actually don't. And the one thing you just mentioned on your show is about interest rates. And interest rates are going higher, even though the 10-year is back to 1.3% from 1.7%. It's still well above the 0.5% it was last year this time, if we were talking. So I think if we think inflation is real, and I suspect it is, if you look at labor, the shortage that's going on right now, it's hard to find workers. We've seen commodity prices rise. That's not great for big tech. And to put in perspective, if those 5 stocks went down 10%, you would need the bottom 100 stocks in the S&P 500 to go up 75% just for the index to stay even. So I think you definitely have to broaden your exposure out here. And we've also seen Biden come down hard here, looking at anti-competitive practices. Are they exploiting our data? Which they are. So I think there's a lot of headwinds here, and you have very high valuations on these stocks. So buying the S&P 500, you're just buying a tech fund in drag. So you got to be careful here. If you want to get that reopening trade, you've got to broaden your exposure. The S&P is just not going to do it.
But if I don't want the reopening trade, a lot of people were down on tech stocks at the beginning of the year, and now they're right back into tech. And the fact is, when you look at the giant that Amazon is, it would take years for the federal government to break them up. As you just talked about, the Biden administration coming down hard. We know he's signing the EO as you and I are speaking right now. So for those of us who have benefited, S&P 500 up 16% year to date. A lot of that, as you just pointed out, driven by tech. Why wouldn't we want to just stay in with tech?
Well, the old saying is too much of a good thing becomes a good thing. And if you look at Amazon specifically, it's underperformed the market by about 20% since last September, which kind of coincides with the reopening of the economy trade, right? That's when the vaccine news started to come out. That's when you start seeing money go into that rotation of cyclicals, energy stocks, financial stocks, which have dramatically outperformed this year, well above what big tech has done. And it's 60 times forward earnings. And if you look at big tech in general, Facebook, 30 times forward earnings, Microsoft, 30 times forward earnings plus. These stocks have a lot of good news baked in. And you can go back to right after the tech bubble burst back in 99, 2000, Microsoft at that point was one of the largest components of the S&P 500. They tripled their earnings from the year 2000 to 2014, but because the valuation was so high, the stock did nothing. And I think that's what the bigger risk here. It's not a big sell-off in these stocks. It's the fact that they do nothing relative to the fact that other industries, other sectors are starting to pick up and do so much better. And money invariably is going to find it to where the growth is going to be the fastest. And you're at a point now where so much growth is baked into those stocks. That's why they've underperformed so much over the last 6 months, since we've really seen this dynamic of being locked down to business activity picking up again.
By the way, those of us who are myopic and only look at the United States, when you're looking for growth, are you telling people who listen to you, look at Europe?
And I realize Europe has been a very dirty word, Adam, for the last decade. But yeah, I talk about this a lot on my podcast. But again, money's going to find where the best opportunity is. If you look overseas right now, you've got multiples that are much cheaper than the U.S. Growth rates in Europe are going to be faster than the U.S. next year. It's hard to believe that, maybe because they're coming from a lower base here. But you're starting to see really good bargains in Europe. If you look at dividend yields, we know we're getting abysmal yields right now on your money market fund, 10-year treasury again at 1.3%. Well, if you look at dividend growth, it's going to be like 11% a year for the next couple of years in Europe, faster than the U.S. And again, growth rates are going to pick up there. And if you start looking at playing catch up here, vaccination rates are going up big time. They're starting to catch up in regards to where they are in that cycle of that reopening. So if you've missed the boat already, you have money in cash, you definitely want to take advantage of Europe being cheaper. And that's where money's going to flow. The dollar's starting to weaken over the course of the last 12 months. It's had a little spike here in the short term. But my guess is with these trillions that we've been printing basically over the course of the last year or so, that's going to continue to weaken the dollar, which also acts as a little bit of a kicker for your international exposure as well. It's a way to hedge your U.S. currency bet as well, be it as opposed to like cryptocurrencies or something like that.
All right. I'm just going to leave everybody with one tidbit that you supply to your consumers that you shared with us, that the average Robinhood customer had about $5,000 in their account in February. That's a lot less than the average Schwab customer, the average household account having $320,000 in assets. So good to see you. Ryan Payne is president of Payne Capital Management, host of the Payne Points of Wealth podcast. Thank you for being here. Have a great weekend. He was joining us, by the way, from New York City, one of the largest cities in the tri-state area.